The stage you should start thinking about approaching a venture capitalist is the point at which you're so comfortable with your business that it's all second nature to you. And the approach you should take with a venture capitalist is, this is a train, it's leaving the station, it's a business whether you're going to invest in me or not. It's very important that I get some money, but I'll get it. If I don't get it from you, I'll get it from somebody else. And I think the approach really has to do with your knowledge of your business, and whether we fund your company will really be determined by how well you know your business. The decision-making process for a venture capitalist is very straightforward. We scan through business plans. They're all read by somebody in the organization. We then make a determination whether we want to meet the candidate. Once we've decided to meet the candidate, then we go through a decision process where the partners all talk about that company. They all determine how they feel about it, whether they think this is something that's going to change the world. Once they've done that, and they believe that it's going to change the world, then they will start to negotiate a contract. As for an exit, we're always thinking in terms of, when we make an investment, we're always thinking in terms of how we're going to exit that investment. There are only really two exits to any investment from our standpoint. Either a company merges with another company, or a company goes public. And the third exit, which we don't like to talk about, is the one where they go out of business. What we're always after is the IPO. We're after entrepreneurs who are going to make the next great American company, great worldwide company, and grow it until it's big enough for the public to appreciate what they've done, and then grow even beyond the public offering. If you're an entrepreneur and you're based in China or India or Pakistan or Greece or wherever, there was a tendency historically for venture capitalists to require that your entire team move to the Silicon Valley. It turns out that now a few venture capitalists, Draper Fisher Jurvetson being one of them, have moved out to you. And we have offices all over the globe now, and so that you can actually start your business in your local country. If your local country has a difficult government that doesn't quite understand how the entrepreneurial business will work, then we'll encourage you to start it up as an American company, but with a Chinese office or an Indian office or an office from Singapore or wherever. A business plan should not be canned. It should not be a standard business plan. Every business is different. Every model is different. Every set of people is different. Every vision is different. Every business plan should be different. A business plan should have all the basic information. It should have the technology, the market, the people. It should have full resumes of the people. And it should have at least cursory financials as to sort of how the business will work, where it's going to go. It does not need in-depth financials. It just needs something for a venture capitalist to take a very good look at and to understand that this entrepreneur has really taken the time to go through and think through his or her business. In order to approach a venture capitalist, it's often good to have an introduction. However, in our case, in the case of Draper Fisher Jurvetson, we treat all the plans that we get the same. We look at every single plan as though it just came in off the transom, whether it was referred or not. We will spend the same amount of time, we'll work the same amount of activity, so just get the plan in. When you come in and visit with a venture capitalist, I think there are a few basic rules. Get your slideshow put together, but don't assume that the venture capitalist is going to want to go through the whole slideshow. We are just notoriously aggressive in asking questions that are not a part of your slideshow. And so don't assume you're going to have time to get through the whole slideshow, but do have all the slides ready just in case we ask that question. You know, we don't care what you're wearing, we don't care how you look, we just care about your business and your passion, your excitement. Be very enthusiastic about what you're doing. Some entrepreneurs want us to sign NDAs. We can't sign an NDA. It puts too much liability out there for us, and we are approached by 50,000 entrepreneurs a year, and we just couldn't have that kind of liability hanging out there. When you're negotiating a contract with a venture capitalist, or any contract, it's always important to put in your mind what you believe success to be, and have the whole negotiation move toward that success, and try to make sure that when you're negotiating, you're thinking in terms of becoming partners, not adversaries, and it'll make all the difference. If you feel like you're going to be a partner, so does the venture capitalist, and it's much more likely to be a great partnership, and it turns out might end up being a better business just because that relationship is so strong. Often entrepreneurs want to know how we value companies. It turns out that it really is more of an art than a science, where we're really looking to see how we can achieve the returns that we need to achieve at the same time as keep the entrepreneur very motivated to do what he wants to do, and make sure all the stakeholders are relatively happy with the outcome. That can mean a lot of things, and so we often take a very large stake in a company, as much as 80%, and we take sometimes a very small percent of a company, something like 10 or 20%, usually more like 20. And the reasoning there is a lot of different things. A lot of different things can make an impact on how we might value your company. Some of it's financial risk, some of it's market risk, some of it's people risk, and some of it is how big is the opportunity and how good's the business model and all of that. Some entrepreneurs are very concerned about venture capitalists, particularly now, asking for large liquidity preferences so that the first money comes out to the venture capitalist and then the entrepreneur is way down or way up the food chain. Well, it turns out that at Draper Fisher Jurvetson, we are always trying to align our interest as closely as possible with the entrepreneur. And so we tend not to want to have big liquidity preferences here. We tend to more want to line ourselves up so that no matter how big the company gets and what it's sold for, there's always a very smooth curve between the entrepreneur and the venture capitalist and how much money they get. The lead investor has a responsibility to negotiate the term sheet with the entrepreneur. and the lead investor takes a very active role in the company and tends to be the lead once the board seats are all put together too. The reasons they may bring in other venture capitalists could range all over the map, but generally they are looking at risk reward and they need a very diversified portfolio, and so they may end up taking where a company is asking for $5 million, they may only want to take $1 or $2 million and share the rest with other venture capitalists so that if the company requires more money in the future, they'll have money to come up with when that future round occurs. The way we do our due diligence, we have a checklist. We have certain things that we like to go through, but we also follow our nose a little bit. We're looking for strengths and weaknesses. We're looking for a consistent past that is pretty much consistent with what the entrepreneur has told us in the past. But in a larger venture firm, what we're really looking for is more good news to tell our partners so that we can get this deal done through the partnership. And so look at due diligence as a very positive thing if you're an entrepreneur. You want them to go do due diligence on you. You want them to talk to all your former bosses and the market, and you want them to talk to your customers. It's generally a very positive thing that they're going through due diligence. Well, it turns out that that entrepreneurs have started very successful companies all over the world. They don't just happen in the Silicon Valley, and I think it's very exciting, and it's a wonderful thing that venture capital has spread as a concept around the globe, and entrepreneurship has spread as a concept around the globe, because this is a really great time if you're an entrepreneur. You have an opportunity to go for venture capital in a lot of different places, and you don't have to move. You can stay, you can live where you live, and you can build a big company wherever you are. Some of the greatest companies were done outside of the Silicon Valley. Microsoft was in Redmond, Washington. AOL was in Herndon, Virginia. These companies were created from really just one entrepreneur or a few entrepreneurs and a real vision. So, the great thing about what's happened to the world today is that entrepreneurs can start anywhere, and venture capitalists are making sure that they're available anywhere. There are some tremendous new technologies that allow entrepreneurs to create new businesses that have come along over the last 3 or 4 years. But what's really interesting is that if you believe Moore's law, and you must because it's been working for so long, that means that every 18 months the capacity of $1,000 of compute power doubles. Now, if you go back 100 years and you think in terms of Moore's law being technology in general, you think of all the things that have been invented in the last 100 years, that same amount of change will happen in the next 10 years, and that same amount of change will happen in the next 1 year after that. So in the next 11 years you'll see 100 years of change twice. So you'll see an extraordinary amount of change. So new technologies are starting to pop up everywhere, from nanotechnology to peer-to-peer technology to bioengineering to the genetic probes to all of these great new technologies. And really good, clever entrepreneurs can make great businesses of them. I think the future bodes fairly well for startups. I think more people know about a lot of the pitfalls that startups have run into historically. And I think there aren't as many of the risks that you take by going off and starting a business. It used to be that you were risking your career, and it was a big social risk, and there was a big financial risk to ever go off and start a business. You still got some of that, but I don't think the social risk and career risks weigh quite as heavily as they used to. And I think the success rate of some of these businesses will be slightly better than it has been in the past. Hi, I'm Tim Draper. I'm the founder and managing director of Draper Fisher Jurvetson. And if you ever want to visit our website, it's www.dfj.com. And we encourage you to go ahead and submit business plans electronically. And we hope that if you're an entrepreneur and you got a great vision and great determination, great enthusiasm, that you'll come and visit us. Thanks.